Morning, everyone. We thank you all for joining this webinar on hedge accounting. We're also pretty much excited today to speak about this important topic. Hedging has and will continue to be one of these complicated concepts within the accounting practice. Myself, Faisal Al-Jasser, joined by my colleague Abdullah Al-Ali, will try today to shed some light on this topic and make sure this webinar is as productive and as engaging as possible. Ihata Financial is regulated and licensed by the Capital Markets Authority in Saudi Arabia. Ihata is an independent financial risk management advisory firm. We are specialized in market risk, including interest rates, commodities, and foreign exchange hedging, as well as valuation and hedge accounting and derivative disputes mandates. We were privileged in the last 2 years to advise on more than Saudi Riyal 20 billions of local exposure and supported our clients successfully with more than Saudi Riyal 3 billion to account for their derivatives. It is important to highlight that Ihata Financial is fully independent and we are not tied to any particular outcome, or any product sold. So for a bit of housekeeping, this webinar is being recorded. We aim to wrap up within 45 minutes, including the Q&A session. We'll make sure to share the recording post the webinar. During or after the presentation, please type any question in the question box in your screen. Your questions will not be visible to the rest of the audience, and we will do our best to address the questions at the end of the webinar or after the webinar due to time constraints. We will also ask 2 poll questions in this webinar with multiple choice answers, and we thank you in advance for your engagement. So up with the agenda. So basically, we'll be covering this webinar an introduction. What is hedge accounting, basically? The qualifying criteria in hedge accounting will be covered here under both IAS 39 and IFRS 9. Types of hedges, is it fair value, cash flow, or net investments? Effectiveness testing, something that we will be shedding some light on. Accounting eligibility also. We'll be giving some examples there, and some of the considerations on a when the case comes on a multi-entity group accounting. What are these some of the considerations we would recommend? Also, we will be looking at structured derivatives and what the standards say about that. And then we have summarized a couple of common auditor questions that we have faced, and we would be sharing that with you as well. We will be ending, of course, with a Q&A session. So I hand over the microphone to my colleague Abdullah to take it from here.
Thank you, Faisal, and greetings to the audience joining us today. I'm glad to see the diversity among the audience. Today we are being joined by undergraduates, public sector participants, corporate participants, bankers, financial institutions, as well as CPAs and auditors. So thank you all for joining, and we hope you get the added value you're looking for. As Faisal said, we'll be having 2 poll questions, so allow me to take you through the first poll question we have. Okay, so as you can see on the screen now, the first poll question is, do you apply hedge accounting? The answers you can choose is either no, we do not have a material instruments valuation exposure, no, we are facing challenges in implementation, yes, but we still find the documentation and testing to be overwhelming, and yes, without any challenges. So please feel free to select the answer that best fits your situation. What we normally see in the market is that either clients are facing challenges in implementation or that they are capable of applying hedge accounting, but find the periodic testing to be overwhelming. However, we'll see where the audience is standing at. We'll be concluding the poll question shortly, so please make sure you submit your answers. Okay, so the results are in. I can see the majority of the audience are not applying hedge accounting, and mostly because they do not have material exposure. Yet 15% are not applying hedge accounting because they're facing challenges in implementation. There's also an equivalent split for those who are applying hedge accounting. Some of them are applying it, finding it challenging to continue applying, and find the testing to be overwhelming, and 25% are finding it easy without any challenges. So thank you for participating. We hope you found the webinar to help you overcome those challenges. Okay, so starting off with the material for today's webinar, the first slide is, as you can see on the screen, what is hedge accounting? Basically, to understand what hedge accounting is, we need to first understand what hedging is. As you can see on the left side of the slide, companies come across financial risk exposures. That exposure can be a foreign currency, an interstate exposure, commodities, or whatever that market risk exposure that they're having. That variability in that exposure leads to swings in their financial performance. Therefore, to overcome that challenge, companies elect to apply a hedging strategy. By hedging, there are the natural hedges, which is the diversification and balance sheet management. If you're having expenses in euros, try to generate, for example, revenues in euros. However, that isn't always in line with the business plan. Therefore, what companies normally do is that they apply hedging strategy through acquiring a financial instrument to offset the fair value or cash flow changes of an existing one or a forecasted one. So mostly financial instruments are like financial derivatives that are acquired to offset a fair value change or a cash flow change of an existing financial instrument. However, that hedge is doing well economically. It is offsetting, eliminating, or reducing the risk that the company is exposed to. When they get to the accounting treatment of that derivative, they found that there is a mismatch. And that mismatch, allow me to elaborate on that mismatch. The financial derivative, by default, will be fairly valued through profit and loss. However, the hedged item is not always carried at fair value. Some hedged items are carried at amortized cost, historical cost, or some exposures are not even recognized yet, as they are not yet recognized because they're not yet, it's merely a forecasted transaction. So if a company has a forecasted euro sales in 2 years, it isn't yet a receivable, so it isn't yet in their balance sheet. So that accounting mismatch between the derivative being carried at fair value and the hedged item being carried at historical or amortized cost or not even realized yet creates that volatility within P&L. To overcome that volatility, the International Accounting Standards Board basically had one of two alternatives. The first was to fair value the entire balance sheet and therefore create the offsetting factor. The changes in the derivative instrument will be offset by the changes in the hedged item. However, the fair value is not always relevant in some cases. Consider an equally amortized loan over 5 years. When a company is borrowing a loan, the fair value of that loan is irrelevant because the company will never realize the fair value of that loan. Therefore, the IASB board decided not to do that decision. Instead, they have introduced what is known as hedge accounting, the topic of today's webinar. So hedge accounting is an exception to the normal accounting rules. The IASB offered the entities the privilege of modifying the basis for recognizing either the hedging instrument, i.e. the financial derivative, or the associated hedged item, that is a loan or an FX transaction or whatever that is. That modification will end up with the required offsetting of the value changes and the hedging instrument and the hedged item. However, given it's an exception, it's a privilege offered by the board. Therefore, they require a certain qualifying criteria to be met. So why would a company consider taking that extra effort? Basically, the key objectives to applying hedge accounting is to achieve better representation of risk management activities and to reduce income statement volatility. Moving into the next slide. So as explained, there is a qualifying criteria to be met. I believe most of you have come across similar content. The hedge accounting was first introduced in IS 39. However, as entities applying hedge accounting continue to be challenged in implementation, they have shifted towards IFRS 9. Both standards require an entity to provide the hedge designation, to document the hedge designation, and that document will include the risk management strategy, the hedging instrument, the hedged item, the nature of risk being hedged, and the way effectiveness is being tested. Second is the eligible hedging instruments. Under IS 39, there was a limited list of instruments. Under IFRS 9, they have added more instruments to the mix, giving the entities, the applying entity, more strategies to apply, different alternatives to apply in managing their risks. The third component is the discontinuation. Under IS 39, discontinuation was optional. Companies could just revoke the hedge designation relationship. However, under IFRS 9, discontinuation is not optional, and it's only done under certain circumstances. Those eventualities are like the risk management objective is not met, and second, any of the qualifying criteria is no longer met. Therefore, that's a discontinuation event. Last but not least, in fact, this is the most changing component in the standard, that is the hedge effectiveness. Under IS 39, the models, the methods, and the requirements were deeply quantitative, challenging to comply with. The standard was requiring a hedge effectiveness ratio between 80% and 125%. However, as entities continue to be challenged in meeting that criteria, the board have then decided to shift into a more judgmental and qualitative approach, that is the IFRS 9. And the IFRS 9, for a financial instrument to be a hedging instrument, a qualifying one, it will need to have an economic relationship. The credit risk should not dominate the value changes, and the designated hedge ratio needs to be in line with the entity's risk management strategy. Going to the next slide. So now that we know the standard and we know what to do to qualify with the standard, we can then kick off the hedge accounting implementation. And the first step is the identification of the type of hedge we are considering. The standard defined 3 types of hedges. There's the fair value hedge, the cash flow hedge, and the net investment hedge. As the names imply, the fair value hedge was when an entity is concerned about the volatility in the fair value of an asset liability. Under the cash flow hedge, however, the fair value is irrelevant and it isn't a concern for the company. What they're concerned with and what the risk that they're managing is the cash flows, is the variability in the cash flows associated to an asset liability. Net investment hedges is a different type. It is a foreign currency specific type. However, it is often misunderstood that net investment hedges apply to transaction FX risk. However, it isn't the case. Net investment hedges are tackling the issue of companies having investments abroad. So imagine a company based in Saudi Arabia that has a subsidiary in Europe. The value of that subsidiary in Europe, assets and liabilities, will be translated back to the parent company. And that translation is impacted by the exchange rate between Euro and Saudi Riyal. Therefore, what the risk that the company is trying to, the parent company is trying to manage is the variability, the impact of the variability in FX rates on the company's value. So upon defining the type of hedge that you're considering, every hedge type will have a different treatment. Fair value hedges, as you are concerned with the fair value swings of an asset liability, what you do is that you keep the hedging instrument, the financial derivative, for example, to be valued at fair value through profit and loss. What you change here is the recognition method for the hedged item. Instead of historical or amortized cost, you can then realize it as fair value. Realizing both in fair value will lead to that offsetting factor that the entity is trying to achieve within P&L itself. In cash flow and net investment hedges, however, you keep the hedged item treated the same way, you do not change it. What you change is that you change the treatment of the hedging instrument, the financial derivative, for example. Instead of fair value through profit and loss, it will be through fair value through OCI. However, as you are taking out of profit and loss, you need to prove that what you are taking out is an effective portion. Therefore, cash flow and net investment hedges require an additional step, that is to conduct effectiveness testing. Moving on to the next slide. So if you are planning to conduct an effectiveness test, the first step is to create something known as a hypothetical derivative. A hypothetical derivative is not something you account for, isn't anywhere in your financial statements, you do not book for it. However, you just create it as a benchmark. The hypothetical derivative is the perfect hedge as per the standard view. So if you looked at your hedged item and you mimic the same terms that you have in your hedged item and created that in a derivative, that hypothetical derivative that is identical to your hedged item is known as a hypothetical derivative. Therefore, as we said, it isn't accounted for. However, a hypothetical derivative is a fair value proxy for your hedged item. It is used in measuring ineffectiveness. It is modeled at inception to have a zero fair value. It do not include any features that are not there in the hedged item. I think it includes all the features that are there in the hedged item. It is only created once upon designation and used as a benchmark thereafter. Moving to the next slide. So once you have created that hypothetical derivative, you will start implementing the effectiveness testing. As per IS 39, although there is no specific method to be used, there is no specific model to be used, a company can apply Monte Carlo simulation, scenario analysis, standard deviation shifts, regression analysis, or whatever the analysis is. However, what the company is required to do is to prove that the hedge is effective both prospectively and retrospectively. On the slide, we have shared one of the most common approaches and methods to test effectiveness both prospectively and retrospectively. We can see for prospective testing, we have the regression analysis. Regression is a quantitative method that assesses the strength of a relationship between two variables. And those two variables that we are concerned with is the hedging instrument that is being used, the actual one, and the hypothetical derivative, that is the perfect hedge. If the values of those two are moving together, then there is a relationship, a strong relationship between those two. Therefore, if the outcome of that analysis is a slope of 80 to 125% and an R-square of 80 to 1, then the hedge is deemed to be effective. Once you have passed the prospective testing, we can then move on to the retrospective testing. And the retrospective effectiveness testing, a common approach is the dollar offset ratio. Basically, the dollar offset ratio measures the degree of change in the actual compared to the hypothetical. So what you will be doing is to divide the cumulative change in the actual derivative over the cumulative change in the hypothetical derivative. If that ratio is between 80% and 125%, then that hedge is effective retrospectively. So upon passing those two tests, you can then start measuring ineffectiveness. The hedge is effective. However, we just want to make sure how much of that hedge is ineffective. To measure ineffectiveness, basically, ineffectiveness is measured as any cumulative change in the actual derivative that isn't justified by the hypothetical derivative. So what you'll do is that you will measure, what you will book in OCI is the lesser of the hypothetical derivative or the actual derivative. If the actual derivative changed by more than the hypothetical derivative, you will take the change in the hypo to the OCI, and that residual that isn't justified by the perfect derivative, that is the hypo, you will recycle it back to a profit and loss. As you can see in this slide, the requirement is deeply quantitative and requires an extensive work. Therefore, companies were challenged in meeting that 80 to 125. Not only that, the requirement has that cliff effect. What I mean by cliff effect is that if your hedge is 80% effective, the change in the hedging instrument will go to OCI. However, if your hedge is 79.9% effective, the entire change will remain in profit and loss. Therefore, companies tend to change their hedging strategies just to comply with that criteria of 80 to 125. Moving on to the next slide. Given the challenge that entities were facing, the board have then introduced a revised version of the standard, that is the IFRS 9. That revision became more qualitative and judgmental. To designate a financial instrument as a hedging instrument under IFRS 9, what an entity needs to prove is that there is an economic relationship between the hedging instrument and the hedged item. They need to prove that credit risk does not dominate value changes, and the designated hedge ratio is in line with risk management strategy. Let me elaborate on the economic relationship. The economic relationship can sometimes be assessed through a simple critical terms matching. However, when the case is complicated and the relationship is not clear, companies can do, they're not obligated to, but they can, to support the effectiveness testing, to use the legacy IS-39 models, regression, Monte Carlo, whatever that analysis that they're doing. But as per the standard requirement, you only need to prove that there is an income relationship, and that can be achieved by simple matching the terms of the actual and the hypo. Once you have proved that the hedge is effective, there is an income relationship, credit risk is not a dominant factor, and the hedge ratio is in line with the risk management strategy, which is key in IFRS 9, then you can start calculating ineffectiveness. The way to calculate ineffectiveness under IFRS 9 is the same as it was done under IS-39. It is the cumulative change in the actual that exceeds the perfect hedge, that is the hypothetical hedge. Moving on to the next slide. So as you may expect, now how to boost effectiveness ratios. If we fully understand how effectiveness is done, how effectiveness is measured, boosting effectiveness ratios is a no-brainer, is an easy task. In a nutshell, the closer to identical your hedged item and your hedging instrument are, the more effective your hedge will be. And the more distinguished they are, the less effective your hedge will be. So overall, what we would suggest is that you avoid overhedging. You do not use proxies. Sometimes, in some cases, proxy is the only available hedging instrument. It is an illiquid index, for example. However, whenever you can, avoid the use of proxies, avoid macro hedges, and avoid embedding any features that are not there in your hedged item. Mimic the same features that you see in the hedged item. Match the dates, match the tenor, match the maturity, mimic the exact hedged item that you have. Simply, the closer to identical they are, the more effective they will be. Yeah, and that's it for me. I will leave the floor to my colleague Faisal to take through the remainder of the presentation. Faisal, the floor is yours.
Okay, thank you, Abdullah. Thank you very much. Okay, so we've chosen here a couple of examples for you. Some of the standard products for interest rates, an interest rate swap and a cap. And we wanted to talk a little bit about the accounting eligibility and just show you how the treatments will look at those two standard products, excuse me, to hedge interest rate. And we will see what happens if hedge accounting is applied or hedge accounting is not applied. So in an interest rate swap, I guess many of you may know, it's a way to exchange one cash flow for another. It's a way to fix a floating loan. So a cap basically is an option, is an asset that basically provide protection against an increase in interest rates above a certain threshold. That threshold is the strike rate of the cap. So one is an option and one is basically like a forward. It's like a linear product. When we say linear, it means that movements in the underlying, in this case, the underlying, in this case, let's say the loan or the cash flows of the loan, movement in the underlying can fully explain movements in the hedging instrument. This is when we say a linear. But when we are talking about an option or a cap, that's not a linear instrument, because movement in the underlying will not fully explain movement in the instrument itself. There are other factors that explain movements in options. So if hedge accounting is not applied for both those standard instruments, as an example, you would find that changes in fair value are all recorded into the P&L, both of them, the cap and the swap, not as interest expense and not at the same time as the hedge exposure. And this is the key here. This is the misalignment, that that's not recorded as an interest expense and not at the same time as the hedge exposure. Of course, there is something we care a lot about normally when we're working with our clients, the potential for volatilities that in the valuation of those instruments that can affect the KPIs, a company KPIs, an entity KPI, whatever that might be, lender covenants or any internal KPIs. So this is something we tend to look at. If those instrument movements are so important and it can affect certain or trigger any breaches in your KPIs, then we need to discuss how we can actually mitigate that. So again, both changes are going to the changes in fair value in the P&L where we're not applying hedge accounting. Of course, there are disclosure requirements that's normal, and the again the valuation volatility could affect companies or entities KPI. Now, what if hedge accounting is applied? So if hedge accounting is applied, as Abdullah said, there is a detailed documentation, effectiveness calculation, and disclosure requirement that need to be done at the time of inception, and then some of that will need to be done in a periodic as the company reports, not designation though. Effective changes in fair value in the swap, if deemed effective, can all be recorded in OCI and recycled as interest expense at the same time as hedge exposure is recorded. So that's a change here to the first case. And when we're talking about the swap, since we're saying that the movement in the swap is basically, if deemed effective, it is actually mirroring exactly in an opposite way what's happening in the hedged item. So most, if not all, P&L volatility can be avoided with such a product if deemed effective. In an interest rate cap, it's the same. The detailed documentation and the other effectiveness calculation, all of that need to be done. Now, in option, there is two ways from an accounting perspective. Option is being looked at in two ways. There is an intrinsic value and there is a time value. So the intrinsic value will be, it's the same. If it's effective, then it's the same. It goes to the OCI. It's like the case with the swap. So you can assume here or conclude that swap is being basically fully explained by its intrinsic value. However, in the option, the part that is intrinsic value of the option, then it goes to the OCI. What about the time value? The time value, that's a component of volatility, a component of time and interest rate. Then here the standard is different. IAS 39, it's very quantitative and it doesn't have that sense of, I would say, there is in IFRS 9, there is more of a risk management approach towards things. So IAS 39, basically, all changes in time value will go directly to the P&L. Now, under IFRS 9, there is the introduction of something called the aligned time value. What is an aligned time value? So IFRS 9 views a purchased option as similar to purchasing insurance cover, with the time value being the associated cost. So it looks at it as how much of the time value included in the premium paid, i.e. actual time value, relates to the hedge item, and apply this accounting treatment to that portion. So we mentioned critical terms match. So when we're talking about the option now, the critical terms here is the underlying, the notional amount, the strike rate, which is basically based on risk management objectives. So let's say the entity say that we will not tolerate interest rates going above 3%. So that's a risk management objective, and also the term. So here we have a problem. The term that matches that of the hedged item period is the aligned time value. Anything more than that is not being explained by the hedged item, and hence should be recognized into the P&L. The way around that is to basically value these options and find what would be the value of these options, valuing an option actually that have an exact critical term that they perfectly match the hedge item, and seeing exactly what would be the residual that is not matching, and that will go to the P&L. So that's an important and interesting introduction to the difference between IFRS 9 and IAS 39 when it comes to the treatment of options. So we can go to the next slide now. So here, that's a different angle. So one of the things we really wanted to share with you in this webinar is something we actually faced, and a couple of challenges when we are dealing with multi-entity group companies, and when we're looking at accounting our hedge accounting considerations. So there are certain considerations here that we need to look at. So with this situation, that introduces an extra layer of complexity. So centralized treasury, in a centralized treasury, realistically, we tend to see a scenario as the upper structure. So in that case, this is where a case where you can find the parent company is actually doing all the hedging activities. You see the hedge instruments there, and the operating companies, in the case of subsidiary 1, subsidiary 2, they're the one who have actually the hedged item. For the sake of example, let's say the hedged items are loans here, and the hedge instruments is a swap. So to hedge these loans. So So here you will find that there is that kind of misalignment, and that's a realistic case. We are seeing it much, and in that case, so where's the concern here? In this scenario, there is a chance that P&L volatility could cause a problem due to this misalignment. So if there are financial covenants that are tied to a certain entity, separate financial statements, such as the ability to pay dividends or any lender covenants, or in general, the effect on a company profile, should investors or stakeholders monitor the financial performance on a standalone basis, then such misalignment should be taken into consideration. Ideally, the case in the bottom right and bottom left is a best fit to handle P&L volatilities. There in the bottom left, you would find the hedged item and the hedging instrument are placed exactly within the same operating company. So the risk, the hedged item and the hedging instrument are in the same place. On the bottom right, you would find that all the activities are being done by the parent. So this is ideal scenarios in terms of to manage the volatility in a multi-entity group. Now, that's not the case in a realistic way. We don't always see that. Sometimes it's there, but we don't always see that. However, in situations such as the upper structure, we tend to work with our clients on placing intercompany transaction or internal derivatives that basically shift exposure from one entity to the other to actually find a way around that kind of structure. So we wanted to put this in this webinar because if applying hedge accounting is on the cards, then looking into these considerations early on will be useful. I think we can go to the next slide. Okay, so structured derivatives. That's also an important topic. A lot of our clients we deal with a lot of clients who have a portfolio of derivatives. Some of them are very much exotics. So it is clear that net written options are not permitted for hedge accounting. Nonetheless, a collar, for example, where a hedger enters into a zero-cost structure by buying and selling options, is considered by many an acceptable hedging strategy. Is this a net written option, though? Unfortunately, the standard is not very explicit around this point. But we normally tend to see that the general practice may not consider any combination of options as a net written option if it does not entail receiving a net premium, meaning you entered into an options or a collar or a structured option, and you have actually received a net premium, meaning you have sold more risk than what have you bought. So basically, you are getting a net premium. So that's not good. If you're receiving a net premium there, that doesn't help. And another case is where the critical terms, of course, are matching between those two options, except for the strike price. That doesn't put it in a position where it could be called as a net written option, and it does not contradict with an entity risk management strategy. And that is very important in IFRS 9. It depends a lot on what the entity's risk management strategy is saying. So that's something that very important to put emphasis on. What's the risk management objectives? On some of the features down there, this is not what we have just described here as a net written option. The features such as knock-ins and knockouts, intuitively, those features, they do not, these are different, and although they might pass, by the way, the effectiveness test, but they do fail on qualitative grounds. So we get to see sometimes with some of our clients how these products actually does create that kind of difficulty in applying hedge accounting, because in principle, to be honest, a hedge in principle should provide unconditional protection and mirror exactly the hedged item. So callabilities, knockouts, knock-ins, they do not help. Callability here in the sense of where normally the callabilities here are in the hand of the hedge providers or the banks, so they can call the hedging instrument you have, and that wouldn't consider the hedge. You get this, sometimes these hedging instruments get called in the most in the time that is actually they are most needed. So that's one important thing. And from the get-go, sometimes we can determine that hedge accounting will not work with those features. Okay, so before we jump into the next slide, it's time for our second poll question. Okay, so in your case, what would be the challenges in applying hedge accounting? It can be we don't have a risk management strategy, the nature of risk being hedged, or the eligibility of the hedging instrument is creating that kind of challenges, measuring effectiveness and economic relationship, or measuring credit risk. It will be interesting to see where's the challenges here. Okay, I guess maybe we, if you may submit your results, so we just can show the, submit, sorry, your answers, so we can show the results. Okay, I think we're ready to see the results. Interesting. Interesting. So we're seeing 50%, the majority here, the majority of our audience is having challenges in measuring effectiveness and economic relationship. Only 15 measuring credit risk, which I thought would actually have a more, honestly, a percentage. And 25, the nature of risk being hedged. This is something I guess sometimes can be, if it's a foreign exchange, for example, when that transaction will be realized and how exactly, at what time at what stage it should be realized of a forecasted sale or something. So that's also can be a challenge. Okay, that's interesting results. Abdullah, you have any comments on these results?
Yeah, in fact, I believe, yes, as you said, the results are expected. But honestly, what I'm happy to see is that only 10% do not have a risk management strategy. And looking at the macro picture, having a strategy is more important. So I'm happy to see that 90% do have a hedging strategy, a risk management strategy. So that's the essence. The accounting implications is just the consequences of acting on managing the risks. So I'm glad to see that 90% do have a risk management strategy.
Indeed, indeed. Thank you all for participating. Okay, so we shall go for the our final slide, I believe. Okay, so this is a summarization of common auditor questions we get to see when we work with our clients. So they are in two folds basically. So it's either designation and documentation question, and that's the qualitative side of it, or either valuation and effectiveness question, and that is the quantitative side of it. So it's basically the hedged item identification and management assumption. What are we hedging? Again, in the case of a loan, we are hedged item identification. It's basically those specific loans or those specific facilities that we are hedging, and what is the management assumptions around that? That's all need to be written down in the designation itself. The fair value recognition method, how are we recognizing our hedging instruments and how we are measuring that? The effectiveness testing calculation method, that's not only need to be calculated, it need to be written down in the designation itself from day one. This is how, going forward, we will be calculating our effectiveness and ineffectiveness also. And of course, intuitively, the supporting documents, that is the term sheets from the bank and the facility letter, if it's a loan, that's all need to be there. And the details of underlying risk index, let's say cyber, the Saudi Riyal interbank rate, if that's the case. So this is the index, this is what we're hedging, the volatility, the change of that index is what we're hedging, and that's all put there in writing in the designation from day one when the entity decides to designate that hedged item to create that relationship between that hedging instrument and hedged item. Valuation and effectiveness, the questions we get to see is, what is the discount curve that is being used? Is it the Saudi Riyal swap curve, or it's the overnight index swap curve? So how are you doing the discounting? And that's I guess a fair question, and it's normal thing to ask. And the forward rate source, what is the source? What's the data platforms? Where are you getting the sources of those forward rates? And of course, we mentioned IFRS 9 required that credit risk does not dominate. So credit risk is being measured via BCVA, the bilateral credit valuation adjustments. This is the proxy for credit risk. So this is there is a methods, different methods, but the questions are, how are you measuring this? And basically, it might be a fancy thing, the CVA, but it's basically, at the end of the day, it's a function of the credit risk of the both two counterparties entering into this hedge. And it's a function of probability of defaults between those two counterparties and loss given defaults and the expected exposure of that instrument, where that instrument will go going forward. So there are different methods to do that, and we get to see questions around that as well. And of course, the full testing, the full working files, we tend to share them with the auditor for them to review. It takes them a couple of weeks for them to look at them and validate that. Once that happens, then designation is done and accepted, and then the treatment starts from that day or from that reporting period. So these are some of those common auditor questions we wanted to summarize with, and I guess with that, before I end, it might look difficult, but however, once the setup is implemented, things becomes easy afterwards. It's become more of a routine as we go with the reporting periods. But at the designation, maybe there are a little bit of requirements, but after that, it becomes very much routine. And we have seen that. We have seen how it become routine with the clients who actually we work with, and they are implementing hedge accounting now. Okay, I guess we have reached the final stage of this webinar. We are happy to address some of the questions posted during the webinar.
I noticed many of the audience are asking a similar question, that is, will the presentation and the recording be shared? Yes, post this webinar, we'll be sharing the questions. We'll be sharing the material, the presentation, and the recording of this webinar. We have a technical question here. Can a company designate part of the hedging? Okay, can a company designate part of the hedging instrument for hedge accounting? Okay. I would say yes and no, depending on what you mean by part of the hedging instrument. If you are planning to designate part of the value, then yes. Imagine if you have two forward transactions, FX transactions, one of 70 million and the other of 30 million. You have entered into a 100 million hedge through a forward contract. So you can break down that 100 million forward contract into two designations. One is tackling the 30 million expense, the other is tackling the 70 million expense. So yes, in that essence, you can designate part of the hedging instrument. However, if you're planning to designate part of the time, then unfortunately you cannot. What I mean by time, imagine if you have a 3-year loan and the 5 years interest rate swap. What you cannot do is that you take the first 3 years and designate those 3 years as a hedging instrument, and you keep the remaining 2 years without any matching hedged item. This is the thing that you cannot do. So yes, you can apply it to part of the hedging instrument if you're considering about MTM value, and no, if your concern is about time, part of the time in that hedging instrument. Hope that makes it clear.
Okay, so that's interesting. We have an interesting question also. The impact on the international standard recommendation for LIBOR transition? That's an interesting question. So this is something I wanted to also mention. As many of you may know, US LIBOR as a benchmark will start to be voluntarily published effective January 2022, and the panel banks will no longer be required to submit LIBOR codes. So LIBOR will eventually be replaced by a new alternative rate that takes out the subjective judgment made by the publishing bank. So the new rate will be based on actual lending transaction that fit, of course, a certain criteria. So this event will have its repercussion on hedge accounting and for clients who has LIBOR volatilities as the hedged item. So answering the question, ISDA is yet to publish a fallback protocol around this, and there have been some amendments to IFRS 9, IAS 39, and IFRS 7 to provide for a certain scope of relief. So it's not yet, there is a lot of uncertainties around this yet, but should you fit within this category, we're happy to assist you in navigating such uncertainty.
I can see another question here, Faisal. The participant is saying we have an interest rate swap. Is there any option with which we can opt not to adopt hedge accounting, say based on effectiveness? I hope I'm getting the understanding correct. What I understood is that you have an interest rate swap, but you do not want to apply hedge accounting for that swap. Then, yes, the overall hedge accounting is optional. An entity can elect to apply hedge accounting or keep their hedges as normal hedges without applying hedge accounting. But what a company cannot do, or it's difficult to do, is that once you apply hedge accounting, you cannot cherry pick the instruments that you apply hedge accounting to. So the hedge accounting is done on an overall hedging portfolio. Whatever is within your risk management objectives, then you apply hedge accounting. But it is manageable to not apply hedge accounting for that swap.
Okay. We are past our time, so we said we will just keep you with us 45 minutes. So I'm just going to take a quick one more question. There's a question of how fast the turnaround can be conducting an engagement. So yeah, so normally it doesn't take time. It depends, of course, the complexity of the portfolio. So if you're talking about a couple of swaps, or it depends, or if there is more optionality, that takes a little bit of time. So, but normally it's like a 2 to 3 weeks. But sometimes the delay basically happens is coming because of the it takes time sometimes with the auditor. It becomes part of the whole auditing process. So they just queue it sometimes until that gets the acceptance happens. But actually doing the whole exercise shouldn't take time. It's like a matter of 2 to 3 weeks again, but it also depends on the complexity of the portfolio. There is another question, and I want to end with that. Is basically the extent of tail risk hedging. Yeah, we have seen tail risk hedging. There have been some. So that's the question of how much in Saudi there was tail risk hedging due to the event in COVID-19. And I guess these are hedges basically that are placed at a certain threshold that manages a certain extraordinary or something that you wouldn't, not expected event or not expected threshold to be breached. So we tend to see tail risk hedging, but the accounting treatment of such will be, there will be with these kind of hedges, as they are not designed, to be honest, for accounting purposes. They are more designed for risk management. They do cover an economic risk, so maybe the treatment will be, the hedge accounting application of it will not be as easy. So with that, we thank you very much for being with us in the webinar. Again, we will email you the recording of this webinar. I thank Abdullah for joining me in this webinar, and we both appreciate the time you have spared to join this webinar. Until we meet again, we wish you all the best.
Thank you. Thank you, everyone.